afternoon. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. It's my great pleasure to introduce Keith McCullough, the founder of Hedgeye Risk Management, and John McNamara, the Chief Investment Officer of Hedgeye Asset Management. KraneShares and Hedgeye have partnered in order to provide investors the opportunity to gain access to the S&P 500 while incorporating Hedgeye's well-known risk ranges. With that, I want to be able to provide investors a great opportunity to learn more about Hedgeye and their global macro process by introducing, again, Hedgeye Risk Management founder, Keith McCullough.
Thank you very much. I appreciate that, Mr. Ahern, and it's good to be with my friend John McNamara. He'll start talking when I'm done ranting. I suppose you guys want me to give an outlook. I'll try to keep it to 15 or 20 minutes. I'll also include processes, because again, the outlook really doesn't matter unless you understand the process. So let's just get into that. I think if you take a top-down view of the asset management business in all of its manifestations, guys, on slide 4, we generally start with this slide in terms of giving a teach-in on our process. I mean, this investment landscape has obviously evolved tremendously. This year alone, I think we're upwards of another 1.7 trillion in ETFs added to the pile that's already mounted to where it is. When I started in this business, which is beyond the pale to the left side of that chart in 1999, 2000, that was not the business. Once I got into the hedge fund business, it was block trading, it was stock picking, it wasn't factor picking, understanding where the signals are going to trigger what we call the machine, the flows of the machine, the quants, Chicago. There's a lot going on out there right now. So I think that the opportunity has always been what it's been, but the timing in particular to launch competing ETF products that, number one, actually hedge the thing. That's kind of an important thing, because a lot of ETFs, let's just be clear, especially if they're passive index ETFs, they don't protect you from drawdowns. Absolutely not. And that's the number one thing that kills your long-term returns. If you only miss one of the 4 crashes that I've risk managed in the last 25 years, you would double your retirement account, okay? So that's a really important thing to me. Risk management first, don't lose money. Again, Charlie Munger, if it was good enough for him and Buffett, it's too bad and it's kind of sad that they don't start with that every day that they speak now. But again, I digress. I got a lot of respect for them. What we're focused on is risk managing that pile so that your hard-earned pile of capital can be preserved and protected so that you actually have an opportunity to compound. Now, just getting into the rates of change of the process. Now, what would get the signal to change, next slide, and therefore the machine? Okay? What would trigger systematic funds or quants to do what they're going to do? Well, it's the rates of change. Okay? And I don't think I get many arguments on that. Gravity is kind of a hard thing to ignore. But if you actually go to the left side of that picture where I use a Sierpinski gasket, really a triangle that I quite like from a fractal pattern perspective, and you think about what we do versus what they do, they start with a lot of economic theory. They'll often say this time is different. They talk about feeling markets, the valuation of markets. That's where they start. Whereas we're very much focused on 3 things: the time series of the data. Again, that's the history. The math that we're using, we're measuring and mapping using stochastic models, fractal models in particular, measuring and mapping the economic data with modern math, not like simple 50-day moving averages, or what I affectionately call moving monkeys, because that would be a one-factor model. Okay, and I'll get into it, but again, we use a multi-factor model that's multi-duration, and that's a big difference too. So again, it gives us a fighting chance to figure out where the economic data is on that sine curve. Most recently, for example, in one of our big calls this year and positioning, it's not just making a call, it's like, okay, what are you going to do with it? Is that inflation bottomed in September at 2.44%. So you're basically right at the bottom of the sine curve, and now inflation's reaccelerating up the sine curve. We don't know where it's going to stop. That's why we now cast daily using real-time commodity prices. wages, et cetera, and it feeds the beast. It feeds the model and tells us where the next inflation is going to print. So voila, 3 months late, P.E. Powell is going to step up today and say, well, we're seeing some inflation pressure reemerge. Of course you are. Again, the currency markets figured that out, the bond markets figured that out, and certainly the S&P 500 and Qs have figured that out. And that's not to say that they don't need to be hedged at some point, but that it's definitely a bullish setup for inflation and what we also call a bullish setup for quad 2. Now, next slide is quad 2. So this is the quads, right? We got Brendan loves this one. This is like, let's get into that quad map, right? Now, when you look at it, your eyes are going to bleed out. You're like, what am I looking at here? So you have 4 different outcomes economically with 2 factors. Again, multi-factor model. This is a very basic one that we built a long time ago. But again, quad 1 is when you have the rate of change of growth accelerating with inflation slowing. That's a real growth environment Americans more broadly particularly like, because the inflation of their cost of living isn't something that they have to get all in a real fuss about. I'd say that would be an understatement right now. On the right side are the 2 quads, quad 2 and quad 3, where inflation's accelerating, either in a good way, where you get what we call quad 2, that's our current outlook. That's where all the fun stuff starts working, crypto, now it's quantum computing, whatever it is, people will chase. That's very bullish for the S&P 500 and for Qs in particular. And then quad 3 is where it's not so much great for everyone because it's called stagflation. So that's where the real growth is slowing as the inflation remains sticky. And then finally, of course, the biggest thing that's helped me risk manage every market crash in the U.S., and that's a pretty big thing. I know I haven't done other things, but I mean, that's one thing that I can do. And again, the number one thing you need to know is when quad 4 is about to hit. The market signals it, the economy cycles it, and voila, that's the big spot where you better be hedged. So that's a big one. Interestingly, like in a 60-40 portfolio, and I'm interested in launching plenty of hedged products. I mean, in quad 2, I mean, if you're long a 60-40, the bond side of your portfolio is going to get killed too. So you got to be very careful in terms of where your retirement accounts are, your asset allocations are, depending on what quad we're shifting to. So that's quad 2. If you want all the back tests on that and bleed out your eyes further, on slide 7, we give you all the data on that. But I summarize it in words on slide 8. And this is the words are actually ranked for what has the best percent return, batting averages, et cetera. So if you look at quad 2 currently, the best place to have your assets on the pivot out of quad 4, which we had in Q3, where commodities are short or an underweight, is to get long commodities. It's basically getting long your prior shorts. So you got that going on, and you have equities, as I just mentioned, but also more speculative credit. So we're currently bullish on high yield, for example, and not bullish on investment grade credit or, as I mentioned, treasuries. So again, that's the setup at the sector style level. We've gotten quite a bit right here. The sectors that you get rid of, which we did right on time in October, would include things like healthcare, utilities, in particular. So those things, healthcare has been the worst place to have your money at the sector style level. But again, the machine figured that out before most people on Wall Street do. Okay, our signal did figure that out, and that's the whole point of building a signal to the quad in terms of a process. And there you have it. So like I said, it's multi-duration. So I have trades, trends, and tails. Those are defined on the sheet. And then, of course, I have a price volume volatility model is how the actual signals are built. So again, very different than a one-factor model, a simple moving average of momentum, price. This incorporates the relationships embedded therein too. So it's what is the rate of change of volatility? What is the volatility of volatility? What is its relationship to the rate of change of the price and to the volume? All that together, we're in the world of AI. The computer figures it out. Imagine I didn't have that. You definitely wouldn't. I don't think Ahern would invite me on any webcast. So that because market timing matters. Now, people that tell you that it doesn't, rather, I believe them. They probably can't do it, right? And some of us can, and that's going to be where active is certainly going to find its place. Active doesn't just have to be a theme. I mean, active risk management, timing matters. There's nothing that matters more than timing matters, and I love it when people say that you can't time markets because we know they can't. That's great. All right, now let's just jump ahead to some of the nowcasts in terms of like what the GDP model currently is telling us, and we just had an update on the model actually last night. Drago and my big team. We have over 40 analysts on the research team. On my macro team alone, we're a half a dozen. So we're constantly measuring and mapping 50 different countries. The one that we're going to focus on for this webcast is, of course, the US USA model, and that's the one that most people care the most about. Slide 23. So you can see our real GDP nowcast. We're not calling for a recession. I think a lot of people did ahead of the election. That didn't happen, so that's a problem for them. But again, you can see that if you take, that's the year-over-year GDP. If you go to what this actually means in terms of how Wall Street will read GDP, which is on slide 25, what we have is, and they call that the quarter-over-quarter SAR number. Really sophisticated when you say it with an accent, right? Okay, there you go. It's completely useless, right? I mean, but the fact of the matter is we can front run it. And what we see now is actually a rate of change acceleration in GDP coming out of Trump's inauguration in January. We have a big, what we call a monthly quad 2 as well, which I'll show you in a second. And then, of course, we have the inflation. So on slide 26, while the street is trying to get, they're kind of hoping and praying, right? I mean, there's one thing I always say in risk management. Hope is not a process. So if you're hoping that Powell and his boys over at the Fed are going to hit their 2% target, that's all you're doing. You're hoping. And that's what those gold bars say. They're not gold. They're actually terrible estimates. There have been very few Federal Reserve committees and or chairmen that have been this wrong this frequently on inflation. Okay? He called it transitory, where that chart was about to take off. We said, no, we have inflation doubling twice. And he had called it transitory at 2 and 3%. It went to 9. Then when it went to 9, it started to go down, and he couldn't understand why it was going down so fast. Then when it bottomed, he said it's going to go down again, and now it's going up. So again, just please pay attention to the nowcasts that are accurate. What Powell says today really doesn't matter to me. The foreign currency market's already discounted a hawkish outlook, so is the bond market, and so is the stock market. So again, there are our estimates. We're going north of 3% as they hope for 2. That's the most important differentiating slide. I think, I mean, obviously Wall Street's going to be bullish on GDP always, but we're not always bullish on GDP in particular when we started the firm in 2008 when our model was saying otherwise. Now we show this on slide 28. Maybe a couple more minutes here. This is what we call our monthly inflation nowcast. So this is the juice. So this is what most of our institutional clients want in real time and pay us a premium for, because we have the best, most accurate being, not best looking, you got chubby me talking about it, but you got the best and most accurate monthly nowcast that updates weekly to Wall Street for the actual inflation numbers. Most recently, we've nailed the number to, in one case, didn't even need an extra basis point. But again, these numbers were very close. And most importantly, we actually have inflation heading up towards 2.94% in the next month. So that's, you're going to have, see where that chart bottoms, where it says 2.44? That's the thing about using rates of change. It's not subject to a political opinion or some person's valuation model. It's an empirical fact. So again, from 2.44, we have it going to 2.94 in December, and that's a 50 basis point raise in inflation, which by all historical measures is a monster move, okay? So as wild and exciting as that probably is for all of you, just to finish up on the monthly quads. So we show that. And what we're looking at here is essentially a monthly quad 2 that hit in October. That was before the election. So our market signal was buy anything that's not locked down before the election, no matter who wins. Okay? This is not a political model. It's an economic model with market signals. And most importantly, you see that 2 for January, and then there's a 2 again in March, 2 again in April. So this is a real nice glide path to be long. So if I'm looking at how I'd set up a portfolio, there's no quad 4 there until we get further out in time. So what I'd be doing is I'd be really grossed up to the beta of the market, or to the equity side, which obviously we are, and fully loaded being long crypto and Bitcoin. So those are the monthly quads. And then finally, just we show this globally. If you go to slide 36, which it matters. I mean, I don't know how people. There's so many brilliant people on Wall Street that couldn't time anything if their life depended on it. But it's really important to have a view that's global. To not have a global model to me is. But basically, you wouldn't have one if you didn't have one, right? That's why they don't have them. So again, if you could, you would. And the outlook, interestingly, for the world is that while the dollar strengthens and interest rates resume their ascent in the U.S., you get the other currencies in the world go down. And there are 160 fiat currencies in this world, okay? So the two things that are really working great now are the US dollar and all the shorts against all the other currencies. I mean, have you seen the political issues that are born currently in South Korea, for example, or in Canada? I mean, these are terrible currencies, and they're great shorts, but they're the other side of the dollar trade. So as we get inflation back into the picture, they get weaker currencies. So think about it if you live in Canada. So I'm from Canada. You can call my dad and ask him, hey, is your cost of living going up or down in Canadian dollars, Dad? And he's like, he'll hang up the phone. Like, are you kidding me? Like, so again, go try it in South Korea. Go try it. You know, it used to be in Argentina. They changed that. A very interesting move politically by Milei. But this is where we're at. So we're essentially going to have Quad 2 in the USA, which is, like I said, as bullish gets, and bearish for bonds, treasury bonds. And you have global Quad 3. And global Quad 3 creates a lot of shorts. And not that you guys want me to go through shorts. I don't think I need to start shorting any KraneShares ETF, right? Right, Brendan? That's not the point, right? You just want to, your assets can go anywhere in our model. And this is a big takeaway to not be long certain countries that have certain Quad 4s in particular. Interestingly, but not surprisingly, one that should jump off the page is France. So I can't just pick on the Canadians. I mean, you got France, right? France is a Quad 4. That's terrible. I mean, look at the political upheaval going on there. So I think that's, and then finally, in summary, we have a slide that shows you the current themes, just to spell them out for you. And that's should at least reflect most of what I just said. You know, to be or not to be Quad 2, we have to be at this point. That's what the signals are saying, and especially into January and the new year, US dollar breakout versus the deficit and debt dynamics. That, by the way, is also a very bullish setup. At least the market expects this is the first administration to even discuss cutting the US deficit in my lifetime. So now that you have that's dollar bullish, right? Especially when the Europeans are raising their deficit. So we have that. And then on China, quickly, I'd say for now, India has been a great position for us for a long time that we most recently got out of. China, we're data dependent, so there's that. And maybe a good spot to stop ranting.
Yeah.
17 minutes.
Hey, great. Yeah, I mean, look, I think, obviously, one of the reasons that I've always been so excited to work with Hedgeye is the tremendous resource that they offer, which obviously Keith just did a very quick overview of. And obviously there's a tremendous amount of intellectual property and different strategies coming out of this tremendous resource, which it's my job as a CIO of Hedgeye Asset Management to try to harness and bring to the investing public. And I think Keith gave a brief overview of the evolution of the asset management business. Obviously, we're a new entry into that, and very excited to provide investors with a better way. I think our first foray into that endeavor is the Hedgeye Hedged Equity Index, which I'll quickly give an overview of. Obviously, as I mentioned, Hedgeye Asset Management is a subsidiary of Hedgeye. We currently are in the business of producing model portfolios and indices that are based on the intellectual property of Hedgeye. As I alluded to, the first product is the Hedgeye Hedged Equity Index, which is available on Bloomberg under the ticker KSPY UI Index. Basically, what we're looking to do here is utilize the intellectual property of Hedgeye in the form of the risk ranges, which Keith kind of alluded to are multi-factor and multi-duration in terms of his price signals. Multi-factor in that they're based on price volume and volatility, and multi-duration in that they utilize Keith's trade trend and tail levels. Just speaking to part of the reason that I was so excited to utilize these in the Hedgeye Hedged Equity Index is basically since Keith started publishing them back in 2015, the S&P 500 has closed within the daily published risk range 83% of the time. So that kind of speaks to the efficacy of the process that is the risk ranges. The Hedgeye Hedged Equity Index is unique in that it utilizes these risk ranges, also in that it utilizes 3 unique option strategies, and that it is fully systematic with it being index-based. So there's traditional risk managed strategies available in the market, in the form of buffered ETFs, hedged equity products, what have you. We're differentiated versus them in that we're really utilizing a dynamic approach to our options portfolio. So the strategy is always running along the S&P 500, but deploys unique options strategies based upon where the S&P 500 is within reference to those risk ranges. So, I think the traditional buffered and hedged equity strategies in the market basically always utilize the middle regime on this slide, which is the within regime. So they're basically long the S&P 500, selling a call to fund a put spread. We obviously also deploy that strategy when we are within the risk ranges. So that is when the S&P 500 is below the sell risk range and above the buy risk range. Where we differentiate significantly versus them is we're utilizing the risk range levels for deploying those option strikes. So in that within regime, we're selling a call at the top end of the risk range, we're selling a put at the low end of the risk range, or the buy risk range, and we're buying a put at the last price of the S&P 500. Where this strategy really starts to get differentiated, and where I think KraneShares has backed us data that they can share on a reverse inquiry basis, where where this strategy has really differentiated itself is in the above and below risk range regimes. Basically in the above risk range regime, we're expecting a fairly immediate term decline in the S&P 500. So in that environment, we sell a call and buy a put, but do not sell that lower down put. Similarly, again, very differentiated in the below risk range regime environment, we expect to see a fairly immediate term increase in the price of the S&P 500, and as such, we do not sell that call, but do want to maintain that constant level of hedging in the product, so we do still deploy a long put spread. How the strategy works in practice is basically the options portfolio changes whenever that risk range regime changes, or we get to the week prior to expiration of the options. So that's a quick overview of the Hedgeye Hedged Equity Index. Some of the conversations that we've been having recently, which I think Brendan will speak to a bit more, and also I'm sure we'll address in the Q&A, is how do we take what Keith just went through and deploy your strategy in equity portfolios. And I think again an area where we've been having a lot of dialogue, and I know a lot of folks are already utilizing this, is dynamically deploying the strategy as a percentage of their equity allocation based on the quad call that Hedgeye is making. And that's an area where we've had a lot of interest and a lot of positive dialogue, and also again an area where we have data that we can share, or that KraneShares can share on a reverse inquiry basis. So, Brendan, I don't know if you want to take it from there, but that's kind of where we stand, where the strategy stands, and the current dialogues, if you will.
Yeah, definitely. And I think on one of the things on slide 14 of the deck, I think it's important that when we launched the KraneShares Hedgeye Hedged Equity ETF, ticker KSPY, we didn't predict a market decline in US equities, but that's actually what we got. And I think something that after 15 years of US equity performance, I think the risk management element of the asset management industry has really fallen to the wayside, that you have people investors or even financial professionals who have never experienced a significant bear market. And the memories of periods from like 1999 to 2009, where US equities generated a negative return, those are very, very much in the rear view mirror. And I think ultimately regardless of what quad we're in, I think KSPY has a really important portfolio application in terms of smoothing out the ride. And we see a lot of investors have put significant amounts of money into buffered or straight hedged ETFs, and KSPY is very much different. It's incorporating the Keith's experience as a former hedge fund manager, as the founder of a global risk management firm and research firm, incorporates all the research John's done in terms of applying this derivative strategy to a US equity core position. And it has fulfilled thus far that outcome. It's given us a smoother ride that when we launched in July, you probably forget already, but the market really did fall, and KSPY gave a lot of protection to the downside and has provided that smoother ride to the upside. So I've had a number of interactions with financial advisors who are very familiar with the buffered space or the hedge space, but I think ultimately you're able to garner all of this experience and expertise in terms of the Hedgeye, not just the quads, but the risk ranges, to keep that exposure on for US equities, regardless of quad, regardless of what the media is telling people. This strategy really has fulfilled that promise thus far. And I think that's where it can play an important part. On the next slide, we have, for kind of compliance purposes, some of the legal slides, and then we can certainly open things up for some questions. If you'd like the KSPY presentation, please email us or any questions for Keith and John to info@KraneShares.com. Or if you're joining us online, you can certainly use the Q&A button. But one of the things that I've thought about is just maybe for Keith, you mentioned your father, obviously retired, but one of the things that I've been thinking just about this incredible bull, and I don't know if you've seen some of these articles about the 60-40 allocation is dead, be 100% stocks. The Wall Street Journal a few weeks ago had an article basically making fun of one of the largest mutual fund families because their asset allocation fund was not 100% US stocks. For particularly old, people who are retired, who maybe don't have the time to make up for a significant drawdown. How do you kind of think about KSPY? It's something where I've got family members who are retired, elderly, have enjoyed this great bull market. In many cases going back to 1981. And yet, there's the potential for risk in U.S. equities. And then can the risk range approach serve that purpose?
Well, it was built to serve that purpose, really. I want to hedge myself. You want to hedge human nature.
We've got an idea for you, Keith. We got a 4-letter ticker for you.
Well, it's interesting, that depiction, of course, Brendan, because it's nonsense, right? Like this morning in the early look, I actually cited how the industry thought that this company called Dimensional Fund Advisors, which I think some of you know, was launching a small cap, product, and people didn't like that at all. That was 1981. Today, DFA runs $800 billion. So again, there is a time and place for innovation in financial products, clearly. Okay. Now, I wouldn't say going back in time, just having an index of 300 small cap stocks is what I'm going to do, because that's boring. It's not differentiated either. But what we do is, because it protects on the answer that you're asking about, which is drawdowns, right? Rule number 1, don't draw down. Rule number 2, don't chase. Those two things, at the top end of the range, you're not chasing, you're selling calls. At the low end of the range, you're not panicking, okay? And that's another thing. Don't panic. I guess put that in as a placeholder as rule number 3. But the model's very smart. I mean, the fact of the matter is that I've not missed a quad 4 market crash. That includes some quick ones, Brendan. If you're about to retire in 2019, well, guess what you got in the fourth quarter of 2018? You got over a 20% crash in the U.S. stock market in the S&P 500. So that our signal nailed that. I mean, I don't. I definitely don't walk around thinking that it's going to 100% nail everything all the time. But it has nailed quad 4 drawdowns when it needed to all of the time so far, and we know why it does that.
Yep. Okay. So one quick question we got, almost technical in nature, was what happened to KSPY yesterday from Dave? Was this a special distribution? And it was simply the dividend that we went ex dividend, so the price of the NAV came down, and then we'll pay that out. But anything to add there, John, just in terms of the distribution yesterday? I just assume it's just simply the mutual funds have to pay out annually, and there was nothing more than that.
Yeah, I mean, you guys are the expert on that end, but yeah, obviously did notice the change in NAV. I believe that there was the distribution, like you mentioned. So.
Okay.
One thing I would add, just from Keith's perspective and kind of the the landscape overall, I think one thing that Keith likes to highlight quite frequently is that Hedgeye risk management. There is there's actually purposely risk management is in the name, and I think to that end, having risk management in portfolios, built in a dynamic way, like we're able to offer with the the Hedgeye Hedged Equity Index, it's really important, to have that, and given we've been talking about the quads, for the first part of this presentation, being able to kind of dynamically utilize the Hedgeye Hedged Equity Index as part of an equity allocation based on the quads, I think is something that that's really going to resonate with folks, and that we've already had a lot of interest in. So again, just trying to tie it all together here and make the research of Hedgeye investable for folks is that's really the goal here. So.
Yeah, and we've got again great questions coming in from the audience, and again, please email us at info@KraneShares.com or use the Q&A button. So a question, Keith, and I promise this is not from someone with the last name Ahern. This is not a question from one of my relatives, but from our friend Jamil. He asks, given the fiscal and monetary stimulus taking place in China, what signal are you? What signal do you have for China, and is there something that's missing that would make you more bullish? That's against the backdrop of the dramatic underweight to China from fund managers against kind of compelling valuations. So just what quad are we in for China, and how do you see those changes taking place?
Yeah, if you go to back to that slide 36, guys, where we have the quads, we can look from left to right on China. And what's interesting about China is that it's always interesting. First of all, secondly, that we have a lot of stimulus, which can change the model. Okay, now you can change short-term economic cycles with epic deficit spending and stimulus. There's this country called the United States of America that just did that. Now China just said that we're going to take our deficit up to 4%, I believe, so that would be a big number relative to where it's been. But if you think about the actual quads and where they came from, our process had us essentially out of China all year up until the end of the third quarter. Then when the quad flipped, you can see that it was actually a quad flip that flipped in the throughout the fourth quarter. It's been hemming and hawing between quad 2 and 3. And the concern here, which is why the answer to the question is, my friends, is not blowing in the wind. It's neutral. We're neutral on China right now because the signal's neutral. It is hovering just right around what we call trend. Now, if it were to break out and those 3s that are pending on the economic data turn into 2s, that would be easy to do because inflation is going to reaccelerate in China because they're coming from the lows of inflation, which you can see on the far side there. China only had 0.5% inflation, headline inflation in the third quarter. Right, so they were coming from the low on the sine curve, Brendan, like for inflation. So you're going to have inflation. I don't think there's any case to be made fundamentally that taking the deficit up to 4% is not going to be inflationary. And by the way, as you know, China imports inflation through a lot of products that the U.S. Sends them. So in particular, and you also have a particularly interesting catalyst for more of that you and I and Terry talked about yesterday. In terms of U.S. agriculture, as he said, Xi wants safe food, and guess who's got a lot of corn? We do. So that's inflationary. We're long corn, for example. So there's a lot going on there. I'm in wait and watch mode, and if there's a signal to buy China, then I'll do that.
Yep, and it's a good thing you didn't bring up ethanol with Terry yesterday, Keith, because he'd still be talking.
Okay.
Yeah, we got another great question here from Jim. Just for both Keith and John. Just what would be your thinking around the minimum and maximum holdings for KSPY? Based on the quads, how do you think about owning KSPY versus not owning it? I'd be kind of curious how you two gentlemen think about it, and then maybe I can kind of chime in there as well.
I'm smiling because what I like about that question is I've had it frequently, and I tried to explain it to my brother the other day, and he's like, he's not. He runs a McDonald's franchise. He's not a quant, trading Tesla or anything like that. But he's a wealthy man who's looking to preserve and protect his pile. So he said, well, how would it work? I said, okay, just let's use some simple numbers here. If we're going into a quad 4, it should be 80-20, at least. KSPY 80, S&P 20. If we're going to quad 2, it should be the opposite of that, because those quads are opposite. He's like, oh, that's it? I said, yeah, that's it. You use SPY and you use KSPY, and that's how you would blend it. Quad 1 would probably be very similar, John, in terms of the back tests. Of you want to be long SPY, right? Your hedging needs to happen, and your reduction of gross exposure to outright SPY alongside that's the big exposure in human history that everybody has. Like who would want to hedge it? But definitely quad 4 is where I don't know what answers you've given people, but.
Yeah, I mean, look, I think, just in the spirit of, keeping things relatively simplistic, we've kind of looked at, just incrementally stepping up and down, the asset allocation based upon, the quad that we're heading into, and, kind of doing that on a quarterly basis rather than, intra-quarter. Again, just acknowledging the fact that, people are looking for, something more simplistic. And like I said, we do have data on that we can share. But, I think that, the bottom line is, you want to have risk management in the portfolio at all times. There are obviously, I think, like Keith says, it's the particular times that matter. And, I think heading into those, those quad 3s and quad 4s, where certainly things are more uncertain. Volatility is likely to be higher. That's a time when having that risk management is really paramount, and those are the times where we would really be looking to be in the closer to 100% equity allocation. If that makes sense.
You see, just quickly back on slide 30, Brendan, because you mentioned July, right? So July we were explicitly calling for, because the signal and the quad model were calling for a quad 4, it ended up being a quad 4, all right? That was the only month that you needed to be positioned for that, okay? Going back to April, and you can go look at what happened to the S&P 500 in April. So again, this isn't magic, it's math. And I think it would be more magical to tell me that those things can't happen, because I wouldn't believe you.
Yeah, well, at times it can feel a little eerie. I just think where you went short U.S. tech in August, and everything is literally like the next day. You mentioned getting bullish on China. That was pre-stimulus announcement. I mean, so it's kind of to your point where this math, this process that's filtering down. is not thinking about, the mainstream media. It's not thinking about who's winning the election. It's not thinking about all these, distractions. It just doesn't. I think that's what we've been thinking a lot about, is just how do you use KSPY in conjunction with your core US equity position, and just simply owning both and just thinking about rebalancing between those two, provides a really, really nice outcome. Because if US equities are running, obviously KSPY is gonna participate. It's not, it doesn't have a beta of 1.5. It's not, but it's going to participate, and then that's almost a signal of, wow, like this outperformance versus KSPY. Maybe that's the time, based on a change in the quads, that you rebalance back. And that's actually one of the questions that we got, Keith, is just for those of the viewers who maybe aren't as familiar with Hedgeye risk management, your actual research. And I don't mean to put you on the spot, but would you be willing to maybe share just the slides that you showed, just to help give investors a little bit of a taste? I mean, obviously, right on hedgeye.com, you really do provide some great educational information for free, but wasn't sure if that would be okay.
Yeah, definitely. We use this thing called AI for some of these cool slides that we have now.
You gotta take credit. You gotta take credit yourself.
We also have a cartoonist for people that. What you find with cartoons is that you can actually teach people macro with pictures better than you can with the written word, right? And not a lot of people like to read. Newsflash. They like it really quick, and we do that too. So if you go to right after the themes, we have the start of the actual content in the presentation. Our cartoonist, Bob Rich, is a beauty. Love that guy. But then we got into the AI, and it's not replacing Bob, but it is the book of macro. Okay, so there you go. And the slide after that is just this. Now, this picture here, if there was any doubt about what I said, now some people will be like, oh, you're critical of Jerome Powell, of the establishment. Yeah, because he got every one of those things wrong, okay? So what we're showing you there is the pendulum of expectations, right? So we ended up, if you go back to the end of 2023, you can see that as the economy was slowing, you put in a bunch of rate cuts expected. Then inflation accelerated 39 basis points. The economy was reaccelerating with epic government stimulus, and they took all those out. Then the economy slowed in July again. What did Powell do? He panicked. 50 basis point cut. They put them all back in, all the rate cuts, and now they're taking them out again. Like, you couldn't be that bad. I couldn't be that bad if I tried to be that bad. Like, you could. We used to have this guy that worked at one of the hedge funds that I had, and I kept asking myself, why did my boss keep this guy running a small book here at the firm? And I lo and behold, he was fading the guy. He was that bad. He was consistently bad. And that was a really valuable thing to my boss. I was like, wow, that's a really capitalistic thing to do. And the guy was a nice guy and everything. He was just terrible at his job. So but there's value in that. And the value is to fade the Fed, okay? And people are like, don't fight the Fed. I don't like to fight the establishment media. I like to read the media. Yeah, whatever you need to do, you go do that. But what we're trying to tell you to do is to front run the Fed, okay? I want to tell you what my signals are going to be able to tell you, and they, across those four pictures, have nailed every one of those moves. And that's a real important thing to nail if you're trying to get bond yields, the dollar, all of the U.S. stock market right in the aggregate. So that's a big thing. Another big thing would be our Bitcoin research, Brendan. Not that I want to make this a Bitcoin presentation, but the next slide is it's illustrative, I think, of you tell me what the signal is. We're talking about KSPY. We're talking about SPY. I could show you this on TLT. I can show you on BTC, on Yeah, You and Me. Whatever you want to do that ticks that I've measured and mapped. Look at the efficacy of using the risk range signal to get in and out of Bitcoin instead of hodling, right? Once again, your return is north of 2 times being long Bitcoin as opposed to bag holding the drawdowns and crashes. Okay, the red is where the trend signal went bearish. The green is where it went bullish. So we're really proud of that. I mean, why am I really proud of that one? Well, because it's the hardest thing to model because it has the highest volatility of any asset class that ticks. That's hard. you know, when volatility whips you around, but it hasn't whipped the signal around. And I do think that the embedded principles and factors embedded in the signal, not to geek out on you, but the fractal dimensions in particular, they're really smart at understanding what's coming next. And again, this doesn't just happen in Bitcoin loves quad 2, so sniff that out pretty good. Bitcoin crashed twice during quad 4 in the third quarter. You know, when July happened, and NVIDIA went down 27% from its June high, and Bitcoin went down 21%. And that was a quad 4. So it applies to a lot of different things, which, as you can imagine, the imagination of Brendan Ahern is live and kicking on how many of these types of hedge products we can create, because they're all based on the same methodology. So I also think that there's a big, interesting opportunity here post-election to get some things which were downright, you know, slowing. Slide 51, like labor. A lot of these things were largely a function of the small business community in America, which is 99% of businesses, just not even being in a recession. They were in a borderline depression. So what we ended up with were these deteriorating labor dynamics. This is partly why Powell gave himself the green light to cut by 50 basis points. But you know, if you look at some of these things that have most recently turned, I don't know if you guys can jump way ahead to the NFIB survey, but before I get there to slide 57, this was the political setup. So if you think about this in full, and this is across surveys, you know, this is showing you the uncertainty ahead of the election, with companies again canceling, pausing, delaying, you know, investment activity and hiring. Post that, these numbers, in particular on the NFIB survey, which I may or may not be able to get to on time here, but it has gone vertical. Okay. We just saw the biggest move in small business confidence, revenue expectations, hiring expectations of the modern era in 1 month. Now, that doesn't mean that you have to be a Republican to believe it or a Democrat to believe it. I'm neither. I'm Canadian, okay? And I know what that data means, and that data means that the labor data is probably going to improve starting in January, and so is a whole bunch of other data. And guess what? That's what Quad 2 is telling you. So I do think that there's a lot of pent up in there. There's certainly a lot of angst. You know, you still see a lot of angst ahead of what we call macro tourist days, like today, the Fed. Okay, everybody's got to react. No, the market's been discounting it for 3 months. You need to react, but we don't need to react. What we need to do is get the next 3, 6, 9, 12 months right of the trend of the economic cycle. So, you know, we think that there's a lot to think about there, including, just to hit on it quickly, the Doge, okay? So if you go to slide 70, nobody really knows what's gonna happen, which to me is kind of exciting, because it creates doubt, it creates fear, creates, I think as my friend Ted Lasso would say, it smells like opportunity, right? So you end up with this thing where people actually don't understand Elon. I don't either, but he does have this thing, guys, go to the slide that shows his algorithm, okay? The algorithm is what he calls it. Now, if you haven't read his book, Walter Isaacson wrote, Elon gave him full information, and it's all there, the good, bad, the ugly. And you can really get a sense for how methodological he is in terms of approaching things like, okay, can I make that part of a spacecraft cheaper? And having bureaucrats tell him no and saying, yes, I can, do it again, do it again, do it again. Cancel, cancel, delete, delete. That's how he operates. So again, he's operated that way for better or worse, you know, for his whole professional life. And it's worked sometimes in big ways. In other times, it's completely fallen on its face. Like, did you see the burrowing company that he tried to start? I mean, he just makes stuff up, and it's very creative and fun. I get a lot of people love the guy. I'm not a fanboy of any of these people that are super popular. I'm just trying to risk manage them. So I do think that people are going to be surprised, and I think the market looks at some of the initiatives in terms of cost cutting, deficit cutting in particular, as something that they're doubting until it actually happens. Now, on one side of the ledger, it's going to be bad for the economy, for the government spending side of the economy, because that's what buoyed the economy during an election year. On the other side, 99.9% of American businesses are small businesses, like Hedgeye, less than 500 people. Okay? Now that, you cut their taxes, I don't know one American who's built a company who's like, nah, I want you to raise my taxes. absolutely something not. Okay, so that's not what we're seeing in the data. In fact, we're seeing the opposite. So you get the growth initiative, which is largely reversing the CapEx plans, the investment activity, the hiring. And I think, Brendan, just to stop talking again there, that's what the market is signaling, which is bullish quad 2.
Yep. No, listen, talking macro is you're like ethanol with Terry, you know. One good question here, John. Obviously you've got your background really on the derivative side. Is how do you kind of think about KSPY versus some of the strategies out there that are really call writing funds, which KSPY is not, right?
Yeah, I would say, obviously, I think that those strategies have become, particularly popular, given, kind of the large yield numbers that they throw out there in terms of, masquerading as, as income products. We're definitely much more focused on the total return with this product, and as such, basically trying to utilize the options positions, to really tamp down that volatility and provide that that downside risk management. So definitely much more focused on the total return than just the the yield as those products in the market that just focus on the call writing are utilizing.
What's also interesting on that, Brendan, is sorry to interrupt, but it's in my head right now, because we bought part of a company called Tier 1 Alpha. So what that does is on a daily basis, it dissects the flows of the options market. Okay, now the options market has obviously become an epic bubble. We have over 50% of daily options that trade are 0 days to expiration. That was only 30% 3 years ago. And you're in this spot where these epic, like on Friday, we have a north of $4 trillion in notional S&P 500, SPX and SPY is going to, thank you for that. But in today's report, Craig, who writes it, wrote about the JP Morgan competing product and its role and what the levels are. The whole market is now front running their transaction. Okay? Now, I'm not here to say good or bad things about JP Morgan's product. I'm just telling you that that's not what we have. Okay? The whole game, when everyone's trying to game the game within the game, you can see that the product isn't what it was when it was initially conceived and very small. So it's got huge market impact. When we think about it, it's dynamic and daily. It can transact any day.
Yep.
Essentially, right?
Yeah.
And there are major differences between those things.
Yeah, I mean the ability to be dynamic and to utilize such unique intellectual property in the form of the risk ranges is obviously a significant differentiator for the Hedgeye hedged equity index, and something that obviously, like I said at the onset, we're trying to provide investors with a better way to access markets, and certainly we feel that being dynamic and not having everyone front run what we're doing is advantageous in that endeavor.
Yeah, and we had a similar question about how do you know you're not over protected or under protected, but that's the beauty of KSPY. Takes those proprietary Hedgeye risk range signals and it's just embedding it. It's doing that and doing it for you. And certainly we've got this very long history of that proves that those risk ranges it's almost
and I think the way that Keith talks about it too is like I don't know, buy low, sell high. Isn't that kind of what everyone's trying to do?
Well, it's actually not what everybody's doing. Everybody's chasing now.
Well, but this is a embedded kind of buy low, sell high type strategy because effectively the delta of the portfolio is increasing as you get towards the low end of the range, and it's decreasing as you get up towards the top end of the range. And I think Keith talks about, behavioral science quite frequently, and it's basically a way to fade your emotions, and having it in a package where all the rebalancing and decision making with regard to strikes, expiration, and the particular options positions that are being deployed is done for you. I think allows for folks to really just take a step back. And not become so emotional in those particular moments.
Yeah, you also get access to what hedge funds have had access to from us for a long time, and pay a super huge premium on that, and they charge 2 and 20, right? I mean, so there are I don't need to name names. We advise over trillions of dollars in asset management, and if those risk ranges, in particular on the S&P 500, aren't in their inbox before 6:30 in the morning, I'm going to have cars in my driveway. Like, there's going to be it's a real thing for real people, generating real returns and charging real premium fees. So that tool, it's one of the tools that actually, arguably, one of the most critical tools is the one for the S&P 500 itself, obviously. But that's if that is a critical tool for them. It's always been my view with Hedgeye: democratize it, get it in the hands of the high net worth investor, get it in the hands of the family offices, because they need it.
Yeah, and look, I think Brendan and I were going back and forth the other day on a very well-known endowment who basically has scrapped their hedge fund allocations in lieu of buffer products. I'm sure that folks can find that article out there, but that's great for them. But I think having something that's much more dynamic and is based on a model that obviously has statistic significance on a robust look back period, is a better way of doing it, at least in my mind. So.
Yeah. Well, no, it's I couldn't agree more. I think it's about protecting against those unknowns, and for a lot of investors, maybe you don't have that time horizon to make things back if the unforeseen does take place. I know we're at the top of the hour, so I very much appreciate this opportunity for Keith, John, and I to introduce the KraneShares Hedgeye Hedged Equity ETF, ticker KSPY. If there's a question that you submitted and we didn't get to, or you'd like the presentation, please email us at info@KraneShares. And again, certainly on behalf of myself and all my colleagues here at KraneShares, happy holidays. Please very much embrace this time with your family and friends. That's what this time of year is really all about. We certainly look forward to our partnership with Hedgeye in 2025 and beyond. And if I don't see you, Keith and John, certainly hope you and your families have a great holiday season.
Thank you. Happy holidays to everybody out there. And thank you, Brendan, for all this. Really appreciate it.
Yeah, thank you.